Uncertainty over the election and the October jobs report driving today's market action. Let's talk about all of it with Morgan Stanley Wealth Management CIO Lisa Shallett, as well as Grant Thornton Chief Economist Diane Swonk. Welcome to both of you this morning. Diane, just on the jobs number, good to see that it was better than expected. Progress to see the unemployment rate goes down to 6.9%, but that job growth is slowing. How would you characterize the state of the labor market right now?
Well, we're still in a very deep hole. We're still down 10.1 million jobs that we were prior to the crisis in February. That's almost half as we've only regained about half of the jobs we actually lost. Another important issue is the quality of job gains is starting to deteriorate. The ranks of those having to accept part-time instead of full-time work just to get any kind of work actually swelled by quite a bit during the month. And the permanent unemployment rate actually did not move down. It's held at 6%, its highest since April, which was it was down below 5% in April, and that's because many of the people who are unemployed are now getting more permanently on permanent layoffs. We're also seeing the length of unemployment go up. Those who are unemployed more than 27 weeks surged more than 1 million during the month. That's really disturbing because we know that long-term unemployment has really scarring effects on the labor market. Those who then try to get a job often have to take a much lower paying job, and there's collateral damage to their mental, physical, and health and the family structure. It even hits the well-being of children. So we're starting to see some of the wounds that were created by COVID start to fester, and the more they fester, the worse the scars will be on the other side of this, unless we can get some cushion on this from the federal government in aid for those people who are now running on fumes as their supplements to unemployment insurance ran out.
Lisa, pretty gloomy picture Diane just painted of the jobs market in this country. The market, though, stocks are barely lower. Treasury yields are higher. We're still heading for our best week for stocks since April. I get that the election is front and center, but why do you think the market is sort of looking through all of this not so pleasant, pessimistic, growth-hurting points that Diane made on jobs?
Because I think that the market is very efficient and effective at focusing on the foundational things that matter at this point in the business cycle. And that is that the evidence that we are in a V-shaped recovery that is unlikely to be materially changed by what happens in Washington remains pretty clear. While there are some concerning elements in, the jobs report, the bottom line is that it was a pretty big number. Unemployment is in aggregate falling, and that comes alongside of other high-frequency macroeconomic data that is extraordinarily solid. Whether you're talking about manufacturing data, you're talking about durable goods orders, you're talking about global trade data, you're talking about U.S. housing data, and you're even talking about U.S. retail sales. Which have held up. Our perspective is one of the reads on the election is that, Americans weren't hurting enough to really demand, fundamental change. And we believe that reflects the fact that, that stock of private savings and household savings that got built up from the first round of stimulus really hasn't fully run out yet. And while there certainly are pockets of the economy that are starting to hurt, we do think that now that we're past the election, we are going to get some levels of fiscal stimulus that include relief for the unemployed.
Shepard Smith here. Thanks for watching CNBC on YouTube.